Sometimes even good stocks fall in value, and that's because the economic environment is an important driver of asset returns. So which assets benefit most from each environment? Well, that's the purpose of an investment clock. It shows where we are in the economic cycle and which investments are best suited to that environment. So the key question now is, what's the time? So let's look at whether it's now time to invest and our explanation of the investment clock in a bit more detail. Let's begin with what we mean by the business cycle. Now, economic growth isn't a steady upward progression. Of course it's not. There are always setbacks. So this is where the idea of a business cycle comes from. We get these peaks in growth, and then we get troughs, and then we get new higher peaks. So it looks a little bit like some kind of upwards and downwards cycle. Of course, in practice, it doesn't look like that. It's not a regular cycle with a fixed period. Personally, I think it looks more like trend growth punctuated with various crises. But the important thing is that the assets which do well during one of these growth phases are not the same assets that do well during one of these contraction phases. The other thing that's important to understand is that the economic cycle usually lags the stock market cycle. So usually what we see is that the stock cycle tops out before GDP tops out. And also, if we look at the trough of GDP, usually equities have already started rallying before we reach that GDP trough. That's because equity markets are forward-looking. For example, if we look at equity sectors, during a period of expansion, that's economic expansion, we'd expect companies to be increasing their capital expenditure. That's because there's more demand for their goods and services, and they have to meet increased demand. We'd also expect interest rates to start gradually rising from low levels. Now, in that kind of environment, we'd expect financials, so these would be companies like investment banks, but also technology companies to do well. Whereas defensives like consumer staples companies, these sell things which you have to buy, like food, but also healthcare companies and utility companies, these would all underperform during these periods of expansion. Then after the expansion, we'd have a slowdown when growth is still positive, but it's decelerating. Now, at this point, we often find that the Federal Reserve would be raising interest rates because inflation would start to creep upwards. In this kind of environment, consumer staples actually do well. These are defensive stocks. So would another defensive sector, which is healthcare. And sectors like consumer discretionary, which would be companies like Amazon, these are things which we don't absolutely need, they're luxuries. But also real estate would be suffering in this kind of slowdown. Then we finally get to a full-blown recession where we get GDP contraction. That means there's less demand for goods and services from companies, there's less consumer confidence, unemployment would be increasing, people are more worried about losing their job. And that means they usually spend less. In this kind of environment, defensives still do well. So that would be consumer staples, utilities, and healthcare companies. And the sectors that would underperform would be cyclical sectors like communication services, but also real estate and technology companies. And then finally, we go to the dawn after the period of darkness, and we get a recovery. Here we're getting an economic rebound, but it's still maybe below trend growth. Consumer expectations would improve, discretionary spending would increase, and businesses stop cutting back on commercial activities. Now, at this point, the Federal Reserve is still probably accommodative. In other words, interest rates are still low. That's because it doesn't want to stop the recovery happening. So in this kind of environment, consumer discretionary, which provides us with those not absolutely necessary luxuries, would do well. So would real estate, also materials. But defensives like healthcare, consumer staples and utilities would now underperform. So one way to respond to the economic cycle is to move your allocation amongst sectors. Before we go on with our explanation of the investment clock, let me quickly mention our membership, which you can see beside me here, and these are the trackers which we provide to our members on our website. You can see that one of those sets of trackers is about tracking the macroeconomic situation for this very reason. For example, if you want to know whether the US is going to be in a recession over the next 12 months, here's a predictive model from the Federal Reserve which looks ahead over the next 12 months. And currently it's flashing a probability of recession of 88%. So if that's true, you might want to avoid riskier assets. Now, if you do want to join our community, you can easily find out more by going to PensionCraft.com, and you can do that by clicking on the link beside me or in the description beneath me. Now, it all seems really simple when you look at one of those diagrams. However, the reality is much more messy. If you plot US inflation, that's shown on the x-axis here, versus growth on the y-axis, this is what the data looks like if you go back to 1948. Notice that the economy doesn't spend an equal amount of time in each of the sectors as the clock would suggest. Most of the time is spent with positive growth and positive inflation. That's where the US economy is almost 90% of the time, in fact. Positive growth combined with deflation makes up another 9% of the time. And then for a tiny fraction of the time, we have contraction, so falling GDP, or contraction combined with deflation, which is very rare indeed. If we want to make things more even, what we can do is look at the change in inflation and the change in GDP growth. And that's what you can see beside me here. Notice that now you've got a roughly equal amount of time spent in each of those four sectors. However, what you often find is that the economy doesn't move smoothly round in a clock. It actually jumps around between these four quadrants. But if we were to use this classification on returns for the US stock market by sector, going back to 1926, this is the pattern that we see. What I've got in the columns here are each of the different US sectors, equity sectors, and the black line you can see is the typical return for each of those sectors over the entire period. But what the bars show you is how those returns change when you're each of those four different environments. The really toxic environment for equity is when inflation's rising and growth is falling. Every sector, when that happens, is below its typical return, with cyclical sectors being the ones which fall most below their average return. So communication, materials, tech, all of those have an awful time in this quadrant, whereas defensives like utilities, consumer staples, but to some extent energy as well, aren't so badly impacted. The sector which is probably best for equities when inflation's falling and growth is rising. This tends to happen early in the cycle. And here you'd go for things like tech, financials, and consumer discretionary, companies like Amazon. So this kind of bears out the data which we've seen so far and taken on faith from third parties. Now, there is a problem with using an investment clock, and that fundamental problem is that you have to predict which sector of that graph you're going to be on in future. In other words, you have to predict inflation and predict GDP growth, for example. Now, as many of you know, people aren't particularly good at forecasting those variables. So unless you've got a crystal ball, the use of an investment clock isn't particularly useful, or at least it's limited by your ability to make those forecasts. If you did have a bit of an insight into where we're headed with the economy, it would certainly improve your returns a lot if you combine that knowledge with an investment clock. With that caveat in mind, let me have a stab at saying, what time is it now? So here's US GDP and inflation coming up to the latest prints which we've got. Now, if we look at growth, you can see that it's come off its peak after the pandemic, and it's kind of stabilized at a fairly low level. Many people expect that that's going to fall further. We saw the predictive model from the Fed, which also predicts a high probability of a recession. So I think it's fair to say that most people expect GDP will be falling. And if we look at inflation, again, it seems as if it's peaked for now, and it does seem to be falling as well. So in other words, we'll fall into that inflation falling, growth falling sector of our investment clock. If we look at the forecast from the Fed's Monetary Policy Committee, which is called the FOMC, their summary of economic projections forecasts that inflation will be falling over the course of this year quite significantly and over the course of next year. At the same time, they expect growth will be very weak, not far above a recession. So they too expect inflation and growth will be falling. So if we take growth and inflation falling as our central case, then we'd probably choose to avoid riskier assets. So these would be things like cyclical stocks. That would include those growth stocks which have already sold off quite heavily, but also things which are riskier like high yield credit in the fixed income space. Usually a recession comes with wider credit spreads, high default rates, and that means high yield sells off. Another risky asset which did badly last year and which would also do badly in a recession would be cryptocurrency. If we were going to buy equity, we'd probably go for the defensive sectors. So that would be consumer staples, healthcare, and utilities. And assuming that interest rates don't increase too much, then government bonds would do well, but so would gold. So there we are. I've gazed into my crystal ball, and that's my prediction of what's going to happen for the economy and what it means for investments. But of course, these things are flawed because we don't know what the future will hold. But at least this lets you structure your decisions and understand which assets do well in which environments. Now, don't forget our offer. If you do want to learn more about investing, but also get access to those trackers, you can do that via our membership. And if you want to learn more about that, just click on the link beside me and in the description beneath me. And as always, thank you for listening.